Hello and welcome to another video about trading Bitcoin derivatives. In my current video I will talk about different Bitcoin derivatives, about the characteristics of each product and my opinion, which products are best to go long, which ones are best to go short, and in which market conditions I would buy and or sell them. Also, I will briefly explain why they help you to figure out what's going to happen to Bitcoin price in short future. As always, comment, like, subscribe. As always, open a new account on Bitmex, on Deribit, and or on crypto facilities with my referral link, which you will find below. That will help you save money on trading fees, and I will get a tiny proportion of that. So let's start with the simplest product that there is, normal Bitcoin exchange, where you can buy and sell your Bitcoin. And if you tend to trade decent volumes, you need to go to a place which has decent volume trading that will save you a lot of money on slippage. And Bitfinex is the biggest platform. It is also the most anonymous to my knowledge. So when you buy one Bitcoin, you are long one Bitcoin and your delta is always 1. When you short it, your delta is always -1. And this is how your delta looks when you go long or short Bitcoin in a place like Bitfinex or any other exchange. It is also great because there is no chance that you can get liquidated if you buy some physical Bitcoin and put it into your cold storage. If you hold it in your cold storage and you do take good security measures, nobody will steal your money. And if exchanges go bust, you still get to keep your money. Now, let's go to Bitmex. Now, Bitmex does not allow you to trade physical Bitcoin for money. It allows you to trade Bitcoin for contracts, and these contracts are synthetic dollars. And Bitmex Bitcoin contracts are inverse contracts, and that means that the delta of these contracts changes over time. So as the price goes up, if you have longed here, your delta will be going down. So that makes it much more profitable to go short in comparison to going long on Bitmex. So let's say that you have longed 3.6 thousand contracts on Bitmex, so you are long one Bitcoin. Let's say the price went up 2 times and now the Bitcoin price is 7.2 thousand. Your exposure is still 3.6 thousand contracts, and since the price went up twice, your exposure is only half a Bitcoin. However, if you went to an exchange and bought 1 Bitcoin, your exposure is still 1 Bitcoin. So this is why it is more profitable to buy Bitcoin rather than buy inverse synthetic contracts on places like Bitmex, like Deribit, and crypto facilities, because in these places you are trading synthetic dollars in inverse contracts. Now, it is not great to long it, but it is awesome to short it. And there are 2 reasons for that. When you have shorted Bitcoin, So if you have shorted 3.6 thousand contracts and the price went down twice, then the price of Bitcoin is 1.8k, and by owning 3.6 thousand contracts short, you are effectively short 2 Bitcoins. So as the price goes down, your short actually becomes bigger. So this is one of the reasons why short Bitmex swap is my favorite position in crypto. Another reason for that is the funding. So as I've mentioned in my previous videos, Bitmex came up with their basis, which is 0.01% funding base. Let's find the calculating funding. It is not here. Anyway, funding on Bitmex is based not only on how many gamblers go, or any users go long or short, but it also adds 0.01% to every funding, which is being paid by longers to shorters. In other places like Deribit and crypto facilities, there is no such funding basis. So that reflects the fact that it is more expensive to borrow Bitcoin in comparison to borrowing US dollars. And this is natural. It should be more expensive to borrow Bitcoin than US dollars, but in my opinion they have overdone this, and that equals to 10% a year. So I think it should be around 3% a year rather than 10% a year. And I think by making it 10% a year, they are making it very lucrative for shorters, because not only they are making that basis of 10% a year if you average over a long period of time, but also they are being short inverse contract, and inverse contract is great for shorting. Okay, so we have talked about the inverse Bitmex swap, but there are also inverse futures, and they work very similarly. So these futures contracts are inverse, and just as with the Bitmex swap, with these contracts it is more profitable to short them rather than to be long. Now let's move to Deribit, and Deribit futures are the same as Bitmex. They are inverse swaps. However, Bitcoin options are different. If you buy an option, you are long one Bitcoin. So if you buy one option with delta 1, so let's say that you buy an option with a strike price of $1, it will be essentially 1, the delta will be essentially 1. So if you buy an option with a strike price of 1.5k, it will essentially be delta 1 Bitcoin. And if Bitcoin goes up in price twice, the delta will still be 1. So that option allows you to buy 1 Bitcoin at 1.5k, and as Bitcoin price goes up, your long position does not shrink as it did shrink with the inverse contract. So at some point the delta of that contract has gone to, of that single option contract or single option has gone to 1, and it doesn't go above 1. So by buying, for example, this option, which has delta 1, you can be at best long one Bitcoin. So, or let's go to this 10K option. So it has delta of 0.05. The Bitcoin price has gone from 3.5 to 10K. At this point, the delta of this option became 0.5. And then let's say the Bitcoin price went to 1 million, and your delta will be 1. It will never be above 1. So that single option can never give you a delta above 1. So that's one of the reasons why I like being long Bitcoin options, because when you are long physical Bitcoin or long options, your delta doesn't shrink as Bitcoin price goes up. And if you short an inverse contract, like a futures contract, that futures contract shrinks as Bitcoin price goes up. A very good place to get a better understanding on how inverse contracts are different to physical Bitcoins is this thread by Quantfiction. At the moment it is his pinned thread. It gives you some very good examples showing how inverse contracts, how positions of inverse contracts change with the changing price of Bitcoin. Now there is one more contract which is really peculiar. This is the funniest contract I have ever seen, and this is the ETH USD swap with gains and losses in Bitcoin. So this is actually a mixture of three things: a mixture of Ethereum, mixture of Bitcoin, and mixture of US dollar. So the funding on this product is usually really high, and that reflects the fact that Ethereum and Bitcoin are correlated assets. So the position on this contract is measured in Bitcoin. So if Bitcoin goes up, you are longer Ethereum US dollar. If Bitcoin goes down, you are less long Ethereum US dollar if you have a long position. So because Bitcoin and Ethereum are correlated, and whenever Bitcoin goes up, Ethereum goes up, and whenever they go to whenever Bitcoin goes down, they both go down together. It is profitable to be long this contract in comparison with being long physical physical Ethereum. So you can construct a trade where you are long ETH USD swap on Bitmex, and you are short Ethereum in a place like Bitfinex, and then the more volatility there is, the bigger the price swing, the more you gain. However, you are losing money on the funding. Because of this positive correlation, the funding is usually much more positive than the funding on Bitcoin US dollar. Right, so I have promised you my interpretation of which contracts you should buy, which contracts you should sell. So it's all self-explanatory. You should buy contracts which are better for longing. So buy physical Bitcoin on an exchange, buy Bitcoin options on Deribit, buy call options on Deribit, especially when the volatility is low. And at the moment I consider the volatility being rather low. Bitcoin is a very volatile asset, and the price swings, as we all know, can be very dramatic. So it pays to be long. Normal Bitcoin pays to be long options, and it is profitable to short inverse contracts. So it's reasonable to short the inverse Bitcoin USD swap because it's inverse and because it has this funding basis. So the funding will always be skewed towards to benefit shorters and to be costly for longers. This is why I like shorting XBT USD swap. Another reason is that it is incredibly liquid and you get almost zero slippage there. You can also short on Deribit and short crypto facilities. However, these two exchanges are less liquid. And just as futures contracts are inverse, it is profitable to short futures. Now, I wouldn't short futures when they are in backwardation. As we have discussed, it is more expensive to borrow to borrow Bitcoin in comparison to borrowing US dollar, and this is why in a natural market futures should trade above the spot price most of the time. So I would draw a line probably at 3% yearly. So for a quarterly that would be just below 1%. So at the beginning the quarterly futures for me should be around 1% premium. And this is natural state. So whenever futures go to 5 or 10% above spot, this is an area where I would consider shorting. First of all, because it's an inverse contract and it's profitable to short it. Second, this premium will decay over time. So if a futures contract has 5 or 10% premium, by shorting it you are guaranteed this 5 to 10% drop in relation to spot price. I would not be particularly keen to short futures below 5% premium. Now, when futures are in backwardation, I would consider longing futures, but I'm probably more tempted to buy call options rather than futures, because the call options are derivatives of Bitcoin futures. So rather than buying Deribit by quarterly futures, I would be more keen to buy a call option based on that futures, because all the options are priced and described on the basis of the price of an underlying contract. And for June and September options, the underlying is the June bi-quarterly futures contract. So yeah, this is when I would long. And now how this influences price of Bitcoin. So if we if we consider that the natural price for a futures contract is 3% yearly premium, which I think is fair, anything below that demonstrates oversold derivatives, anything above that demonstrates overbought derivatives, and I consider this a very good predictor of what will happen to Bitcoin price. So if the futures are very oversold, if the futures are very oversold, I would expect the price to go up. That to me means that there are a lot of gamblers shorting, and they will be forced to buy when the price goes up. Now, when the futures are going very high, that to me means that there are plenty of gamblers buying these futures, and when the price goes down, they will be forced to sell. Now, when the futures go up very high, I would consider that the counterparty shorting these futures are not gamblers, not purely gamblers, but mainly arbitrageurs. And arbitrageurs never get wrecked. So the price could go down, but the price going down will not deleverage the arbitrageurs, because they always manage risk properly and they will never get deleveraged. And overall, long-term futures and derivatives don't change the price of Bitcoin. So they change short term. If they are oversold, that means that the price of Bitcoin without them would be higher. And if they are overbought, that means that the underlying price of Bitcoin would normally be lower if there were no derivatives. However, there is one place which shows Bitfinex BTC USD longs and shorts. And these are available through TradingView. And that just shows how many margin longs are there on Bitfinex and how many margin shorts are there on Bitfinex. And while derivatives are a zero-sum game, for every long contract there is a short contract on Bitfinex. For every margin long, you don't need a counterparty who is taking a position of the other direction. So you can see some periods of time when so these are the longs and the line are the shorts. We can make them look like regular, and you can see here that there are only 20,000 Bitcoin shorts and 35,000 Bitcoin longs. We can show the Bitcoin US dollar price together with them and move it to the pane below, and to some degree when there are plenty of shorts, that the price tends to go up, and when there are plenty of longs, the price tends to go down. So I use that as a useful indicator. When people have borrowed a lot of dollars to buy Bitcoin, when the price goes down, they have to close their position. They are forced to close their position. They have their stops, and this is the logic why I think it does predict the Bitcoin price to move to some extent. Now, so here you can see that people have borrowed. At this point, people have borrowed 35,000 Bitcoins. So people have longed 37,000 Bitcoins, but they have shorted only 20,000 Bitcoins. So this is not a zero-sum game. There are some Bitcoins available for to borrow in the form of loans, and Bitfinex margin market is not a zero-sum game like the derivatives markets are. So this is how derivatives influence the price, and this is how margin positions on Bitfinex influence the price as well. Now you can look at loan markets for different coins, but Bitcoin is the biggest one. It kind of dictates the price of different coins. So I would pay my attention to BTC USD derivatives market as the biggest one, and the influence of the other markets to the overall crypto market is smaller. Right, so I think that is it. Thank you very much for your attention. Please like, comment, subscribe. As always, please open a new account on Bitmex, on Deribit, and or on crypto facilities. You will use my referral link that will save you 10 to 20% on trading fees. Thank you very much for your attention.